If you are currently juggling 3 or 4 different debt repayments, a business loan here, a credit card there, maybe an equipment finance payment, and a supplier invoice on top, you already know how much mental overhead that creates, different due dates, different interest rates, different lenders to deal with. And very often you are paying more in total than you need to be. Business debt consolidation is the process of rolling all of those separate debts into a single loan with one repayment, one lender, and ideally a lower overall cost. And for a lot of Australian small businesses, it is one of the most practical financial moves they can make. Let me explain how it works and when it actually makes sense. The process is straightforward. You apply for a consolidation loan large enough to pay out your existing debts in full. Once approved, those debts are cleared and you're left with a single monthly or weekly repayment to the new lender. The goal is for the new loan to have either a lower interest rate, a lower repayment amount, or both compared to the combined cost of your existing debts. The most immediate benefit for most business owners is cash flow. If you are currently paying 4 separate repayments totaling $8,000 a month and a consolidated loan brings that to $5,000 a month, you have freed up $3,000 of working capital every single month. That money stays in the business and gives you breathing room. The second benefit is simplicity. One payment, one due date, one lender to deal with for business owners who are time poor, which is most of them. Removing the administrative load of managing multiple debt obligations has real value. Now, when does it make sense and when doesn't it? It makes sense when your combined debt repayments are straining your monthly cash flow, when you are paying high interest rates on multiple facilities, or when managing multiple loans is consuming time and creating risk of missed payments. It does not make sense if your existing loans have early repayment penalties that offset the savings, or if you are close to paying off your existing debts anyway. In those cases, the cost of refinancing may not be worth it. There is also one common mistake to avoid. After consolidating, the credit cards and facilities you paid off now have available capacity again. The temptation to use them is real. If you do, you end up with a consolidation loan plus new debt on top, which puts you in a worse position than you started. The consolidation only works if the old facilities stay at zero. When you are choosing a consolidation loan, compare the total repayment amount across the full term, not just the monthly repayment. A lower monthly payment over a longer term can end up costing you more in total interest. Always ask for the total cost in dollars before you sign. The link in the description takes you to a free loan comparison tool where you can see consolidation and refinancing options from multiple Australian lenders side by side.